Hello, I'm Raul Elizalde with a quick take on the markets. Well, there is much to love in the stock market. It went up 100% since the lows of 2009. But there is also good reason to fear the stock market because it can take a lot away from you when you bring your guard down. In the last 3 days, for example, investors in US stocks lost about 3% of their money. And I'm sure that some feel cheated because they didn't see this coming. Now, of course, in hindsight, everything can be explained. Libya is the largest producer of oil in Africa, larger than Nigeria even. So it's logical that with all the riots there, oil prices would go through the roof. And when we see how much commodities of all kinds have gone up, it was inevitable that stock prices would plunge. Well, in hindsight, that is easy to say. But did we have any clues? Well, maybe. One that we may have missed was the VIX. The VIX, or VIX, is the index that tracks the implied volatility of stock index options. Now, you don't need to know exactly what that is, only that it measures how much people will pay for protection against the market plunge. They call the VIX the fear index because people pay up for protection when they are scared. The VIX reached very high levels during the worst day of the financial crisis. But since then, it has come down to much more normal levels, where markets usually trade when they have normal levels of uncertainty. Now, in December and in January, something happened. The VIX reached the lowest levels since 2007, and that would be consistent not with normal markets, but with very euphoric levels, like markets that have nothing to worry about. Now, this is not entirely unjustified, because the stock market had rallied not just 100% since the bottom of 2009, but 25% since August last year, in pretty much a straight line. Now, insurance got very cheap. Apparently, people didn't think that anything could go wrong. But in hindsight, considering how much is still unresolved, such as European debt, US deficits, Chinese currency, Middle East uprisings, etc., complacency may not have been fully justified. Now, chartists or technical analysts usually maintain that once the VIX gets too low, the chances of a market plunge go up, especially when there are negative issues simmering below the surface. Now, a very low VIX implies that investors have let their guard down, and that creates ideal conditions for a reversal. Another reason for equity price decline of the last 3 days may have been that the gains of the stock market since August 2009 were so large that people were sitting on very large paper gains, so they saw the opportunity to take profits. So certainly a bit of profit taken may have had a role to play. So what next? The VIX didn't go up too much. In fact, it is still in a long-term downtrend, despite the jump from last week from 15 to around 22. In fact, 22 is still at roughly the historical average. The thing to watch now is whether it moves to a higher range. If the VIX settles in the middle to upper 20s, then that would probably be an indication that investors will be more skittish going forward, rediscovering fear, so to speak, and quicker to take profits or cut losses. So in the short term, a little fear may be a good thing, although there is no yet need to panic. For more information, please visit us at www.pathfinancial.net. And Raul Elizalde, thanks for watching.